Hey, everybody, we are going to talk interest rates today. Where are they going in 2024? Before we do, please take a minute and click subscribe to my channel and check out the link you see on your screen for a message from my sponsor, The Motley Fool. You can get the top 10 stocks to buy right now. So, Tyler is joining me because I tend to be a little too optimistic when it comes to interest rates, and he kind of keeps me grounded with them. But we're going to take our best predictions of where interest rates might be heading in 2024 based on what we know now, based on what we think is going to happen in the economy, things like that. So before we get into it, let's talk about what the experts seem to think. Every other Federal Reserve meeting, so 4 times a year, the members who actually make the policy, the members who vote, they issue their projections. So as of the September projections, which were the latest ones we've gotten, the Fed thinks that in December they were still calling for one rate hike by the end of the year. They were calling for a federal funds rate of about 5.1% by the end of 2024, which implies one rate cut from the current level. They were calling for a 3.9% federal funds rate by the end of 2025, which would be a total of 6 rate cuts over about 2 years, and a longer run interest rate of about 2.5%, which, let's be honest, they've been calling for a longer term federal funds rate of 2.5% since I've been following the projections. Now, if you ask
And it's
the
never
market
been there.
participants,
And it's never
right,
been there.
and it's never just been there for any significant length of time. It's never been there. Um, so if you ask market participants what's going to happen, you get some different stories altogether. Now, the CME Group, which is the kind of a futures exchange, they kind of track what people think interest rates are going to do based on options markets and things like that. The traders are saying that by the end of the year there's going to be no more rate hikes, which I think at this point everyone pretty much agrees with. That they're not going to raise rates in December. But by the end of 2024, the traders are calling for a total of 5 rate cuts on average. That's the median projection that's priced into the market right now. I've seen some that call for up to 200 basis points of cuts before the end of next year, which would be 8 rate cuts. So, Tyler, I'll kick it to you, but my first reaction is if we get 8 rate cuts next year, that means something went horribly wrong in the economy. But if we get no rate cuts next year, that means inflation will have gotten worse again, in my opinion. Not terrible, not 9%, but worse again. So what's the happy medium here, Tyler? What do you think is going to happen?
I don't know if I can go 100% with you on the idea that inflation has gotten worse because they held things where they are, right? I like to think of interest rates or keeping interest rates above target, above like that 2% rate. Almost think of that as recession insurance in the sense of like, if all of these, if we're not in a recession, we're still growing modestly. We are still, we still have some inflation, maybe within the tolerable range of 2%, but not deflation. And, the jobs market is still doing relatively well, that they're meeting the dual mandate of 2% inflation plus full employment. If you can do all of that without actually having to cut rates, there's actually zero incentive to cut rates because then you're just giving away your recession insurance. It's like, they're not just going to do it out of the kindness of their hearts. I don't assume. So to me, the idea that because it gets closer to 2%, they're going to start cutting, I don't know if I agree with that. I see that as it's been at 2% for a while, or it's starting to trend below the 2% target range, that we actually need to start juicing the economy up a little bit. That's the whole point of cutting interest rate. It's to juice the economy. And if you don't have to do that, you just don't do it. And in my opinion, this is not like anything that is, like I've been diving deep into the beige book for me to disagree with all these, what CME traders are doing. But there's part of me that says there's a certain psychology of us being at 0% for so long. Everyone's just accustomed to the idea of low rates. Like, well, they just have to be low because they've been low. And that's where I disagree. And so, in my opinion, I am more of the idea that 2024 interest rates are more or less going to be where they are. I don't see a whole lot of drastic changes. Maybe, like you said, maybe one or two rate cuts. But beyond that, I don't see it. That, and again, unless something bad happens that they feel the need to juice the economy.
So I'll say that nothing bad would happen, and we'll get like 3 or 4 rate cuts next year. That's kind of my base case right there. So it sounds like you're just a little bit more, hold the line than I am, but not drastically. I don't think either of us think there's any real chance of 8 or more rate cuts unless like I said, something goes horribly wrong with the
Yeah,
economy.
something goes wrong for 8 rate cuts, and if you're betting on 8 rate cuts, you're not bullish in the slightest.
No, if I were betting on 8 rate cuts, I would probably take my money out of the stock market if I thought that was really going to happen. But so there are two sides of what we think are going to happen with interest rates, right? There's the federal funds rate, which if you're a consumer, investors care about the federal funds rate. Consumers really don't, right? Consumers care about things like mortgage rates and what they can get an auto loan for. Sure, your credit card interest rate is tied to that. But if your credit card interest rate goes from 25% to 24 and 3/4, is it really going to change your finances that much? Probably not. But a mortgage going from, say, 7% to 5.5%, that's a meaningful difference. And it's really important for people to know that mortgage rates and auto loan rates do not follow the Federal Reserve's actions exactly. They're not directly tied. They tend to gravitate in the same direction, but it's entirely possible for the Fed to say cut rates by, even 8 rate cuts, like I mentioned a minute ago, and for mortgage rates to roughly stay the same for a while. It's entirely possible for that to happen. It's not the most likely case. So, with that in mind, I actually think that by the end of 2024, regardless of federal rate cuts, which I think we're going to get a few, we are going to see mortgage rates come down significantly. My prediction is that we will see rates dip into the fives by the end of next year. It's a bold prediction, but I think there's a real chance that we will see mortgage rates dip into the fives, even if we get 2 or 3 rate cuts throughout the year. As long as we're trending in that direction, because mortgage rates are more indicative of what people think rates are going to do than what the Fed is actually doing. Would you say that's a fair statement, Tyler?
I don't know if I can go with you the entire way on down into, mid 5 range on mortgage rates, but I could definitely see them coming down because there is a supply and demand component with mortgages, like, you know, Quicken Loans, mortgage originators, things like that. They have to make money, and making money sometimes means bringing in revenue, and they may have to take a cut on their interest rate spread, which is, the amount that they can borrow, which in most cases is something close to the federal funds rate versus how much they can lend out at. Right now, with interest rate or mortgage rates somewhere in the mid sevens, I think, maybe low sevens was the last time I checked. So we're looking right now at about a 2%, 2.5% net interest spread between those two numbers. I could see a compression down to like 1.5, 1, which is not great, but you're trying to actually incent people into the market to actually buy homes and to buy cars, because that has been a struggle. If you've seen it with, with residential housing, sales rates are way, way down. And these mortgage originators and all of this kind of capacity and desire for mortgages, whether it be in mortgage REITs, whether it be Fannie Mae, Freddie Mac, things like that, they need a flow of mortgages to happen. And so, yes, I could see a credit spread narrowing, but if I'm not expecting, more than 1 or 2 rate cuts, maybe 3, I don't know if I can get all the way down to that low of a mortgage rate, but I could see 6.5, 6.3 if we're being super optimistic.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.